All opinions and views expressed by the speakers are not representative of views and opinions of RBC Dominion Securities, Inc. All information and opinions provided in this video are in good faith, but without legal responsibility.
Welcome, everyone, to a deeper dive into discount bonds. This webinar is recorded on Wednesday, November the 15th. Today, we will delve into the intricacies and benefits of these financial instruments called discount bonds. Discount bonds offer a unique opportunity into the world of bonds and fixed income and how they provide superior after-tax returns for savvy investors. We will explore how they work, their advantages, and strategies to maximize their value. So whether you are a seasoned investor or just novice to bonds, discount bonds are a great vehicle. So buckle up and get enlightened in this presentation that we will try to demystify the power of discount bond. Today, to help me do this, I have with me a senior member of our fixed income team, an individual that I have relied on and called on for any fixed income ideas that I've had. The gentleman is Luis Castillo. Luis joined the Portfolio Advisory Group a few years ago after spending 4 years as an associate advisor, helping manage discretionary portfolios and managing diversified asset allocation models. He has a BA in economics from the McMaster University. So without further ado, Luis, take it away.
Perfect. Thanks for having me, Karim. It's really a pleasure to do this and super timely as well. We often label this, discounted bond strategy as the lowest hanging fruit within the fixed income market here in Canadian taxable accounts. And I think throughout this conversation, the goal is really to cover what discounted bonds are, why they make sense in taxable accounts, why the theme is so prevalent in today's environment, as well as the essential ingredients that brought us here today to some of the most, compelling tax-efficient opportunities within the Canadian fixed income market that we've seen in a very long time. So let's dig in. All right. So the first question. So what is a discounted bond? Now when we refer to discounted bonds, we simply refer to a coupon-paying bond that is trading at a discount to its par value, right? So as you know, bonds are issued at par and, will move up and down throughout their life as market forces in the form of interest rates and credit environment exert their influence within that market. So we refer to a bond trading at a price above its par value as a premium bond, and alternatively, we refer to a bond trading below its par value due to market forces as a discounted bond, right? When the price of that bond drops below par, we refer to it as a discounted bond. So in other words, discounted bonds are not a new product. They are the same bonds that we all know. They just happen to be priced at a discounted par currently. Also, it's important to not confuse discounted bonds as the way we will present them in today's presentation with other discounted bond or other discounted instruments such as zero coupon bonds, as such as strips or other money market instruments, as these are not tax efficient. The pull to par in these particular products is not taxed as capital gains. Right, so we'll try to focus the conversation today on coupon paying discounted bonds. Now, why are discounted bonds more tax efficient? Now, before we open up that tax door, I think it's important to take a step back and really chat about what yield to maturity really is. Right, so yield to maturity is essentially the yield metric that is quoted on all bonds and represents the bond's closest proxy of future returns. Right, so it represents the average annualized rate of return expected on that bond if held to maturity, and assuming that coupons are reinvested at that same yield. It also assumes that the bond will not default. Now, the yield to maturity metric takes into account both the coupons received from the bond as well as the bond's natural move to par from its initial purchase price. Now, remember, a bond represents a contractual agreement between a lender, such as ourselves, the bond investor, and the borrower, such as the bond issuer, to pay you back your principal at maturity plus scheduled coupons along the way. Right? So the price of a bond represents the present value of all coupons expected throughout the life of that bond as well as the final principal repayment, right? So the yield to maturity metric is the discount rate that equalizes this present value with the bond's current price. Hence why bond prices fall when yields rise and why bond prices rise when yields fall. Now, this dynamic forces a bond's price to move back to par naturally as maturity approaches. The present value of a bond's remaining coupons and the remaining principal payment reaches par value as the bond approaches its maturity.
So, Louis, can I interject here?
Yeah.
Go back to the previous slide. Can I ask you just to take a 30 seconds or even 5 seconds, so talk difference between the coupon and the yield, the market yield, just to clarify the difference between what was the bond issued at before the coupon and what the current yield is. Can you just take 30 seconds or 10 seconds?
Sure. So, I mean, the coupon rate is, simply the coupon payments that the bond will deliver to its investors throughout its life. The yield, however, is a return proxy combining both that coupon as well as the bond's move to par as maturity approaches. So it's a function of both coupon payment as well as capital gain or maturity or move back to maturity. The coupon payment is fixed in most bonds, in most fixed coupon paying bonds like the ones that we'll cover today. The yield to maturity can move up and down depending on market forces.
Right. Thanks, Louis.
Yeah, no problem. Okay, I mean, so moving back to the actual tax efficiency aspect, the yield to maturity conversation was important to really understand why discounted bonds are more tax efficient. Now, since a bond's yield, and every time I refer to a bond's yield, I'm referring to not its coupon, I'm referring to its yield to maturity, right? So a bond's yield, again, is a function of both coupon payments and pull to par. It is also subject to both interest income tax from the coupons as well as capital gains tax from the pull to par at varying proportions, right? So depending on the depth of the discount to par and the size of the coupon, it will dictate the level of tax that we're paying on either the interest portion or the capital gains portion, all else equal. Now, coupon payment or interest income is taxed at 100% your marginal tax rate, while the return from pull to par or the capital gain is taxed at 50% your marginal tax rate. In other words, in taxable accounts, you want more of your bond's yield to come from capital gain component or the pull to par, because it will be taxed way more favorably than if the bond had a big component being taxed as interest income. Now, a bond or a GIC, for example, trading at 100 will realize all of its yield in the form of interest income. Right? There isn't any pull to par room really to exploit capital gains in a GIC or in a bond that's priced at par, leading to an after-tax yield, which will represent here as the yield that you actually get to keep after the government takes its share, that is equal to its quota yield minus the marginal tax rate. Right? So why is a discount bond more tax efficient? Simply because a bigger portion of its yield will be taxed as capital gains. That's really the crux of the story here. Now, how do you maximize this tax efficiency? You maximize the tax efficiency by targeting the deepest discount to par bonds available, which also happen to come with the skinniest of coupons, right? So in this example, what we have here from our tax experts over at the Financial Advisory Support Team, they illustrate the math behind buying a bond trading at a discount, right? So you're spending, for example, $98,400 for a par value of $100,000. In other words, this $100,000 par value on this bond will cost you just under $99,000. The bond pays a coupon of 6%. So you are entitled to receive $6,000 in income per year until maturity. This is the portion of the bond that will be taxed as interest income after making some adjustments for the accrued interest. But the bond's move from its purchase price to its par value is taxed as capital gain. Again, making some adjustments for the cost base to account for accrued interest. And as you can see here, as expressed on the table on the right-hand side, when faced with two bonds where all else is equal, including their yield to maturity, in taxable accounts, you always want the one with the deepest discount because the tax that you will pay will be much lower.
Now, Louis, if I can just add here, let's go back to the previous, so on this particular table that we're looking at on the right-hand side, we're looking at the discount bond and the premium bond. The discount bond basically shows a purchase price of $99,500. Today, is it fair to say a lot of the discount bonds right now are far deeper discount than that, right? There's bonds that we've bought, anywhere close to, for 100,000, you're almost paying 90,000. So it's a far deeper discount because these bonds were issued a few years ago when interest rates were 1% or less than 1%, and now interest rates are 5%. So even though here the discount shows at only $500 discount, but in many cases right now we can buy a bond which is a far deeper discount, and hence the capital gains is much larger. Is that a fair comment?
Yeah, that's a fair comment. And this is only an example, but I mean, we have the ability to source for bonds that are trading, close to $70. At times from issuers that are AAA rated, such as the Government of Canada, where nearly all of their yield will come in the form of capital gains. So from a tax efficiency perspective, with as little risk as possible, really, because we're considering the highest quality investment grade categories, it's really a slam dunk idea in that we can find, again, bonds trading at $30, $20, $15 discounts to par.
Right. And all that will show up in the capital gains, right? So the deeper the discount,
exactly.
the higher the capital gains, and the better the after-tax return impact.
Exactly. Yeah.
Right?
What people tend to focus on the most is the pre-tax yield, because that's the yield that's quoted on every position. But they forget that, that yield is delivered in many different forms depending on the bond. Some very tax inefficiently and some very tax efficiently.
Yeah. So just to summarize here, Luis, in a GIC, if you're looking at GIC, a 5% GIC, 100% is interest. Basically, it's taxes interest, versus a 5% coupon in the discount bond. That 5%, a large part of that 5% may be capital gains, and hence taxes are capital gains, and that's where the tax efficiency comes in.
Exactly.
Right.
When we're talking about taxable accounts, we try to recommend discounted bonds more so than we do GICs because of that. Because the GIC, its income will be 100% taxed as interest income, and therefore way less tax efficient than a lower yielding bond that happens to have a bigger portion of that yield come in as capital gains. So from a pre-tax perspective, you look at both yields and you see that the yield on the bond is lower. However, the after-tax reality is completely different in that the bond will be ahead of the GIC in many cases by quite a lot because of that capital gain component.
Right. Okay. Yeah. Go ahead, Luis. Sorry to interrupt.
No problem. And I'll get into the details behind that and some of the metrics that we use to really compare a bond and to GICs and make the comparison a little bit more apples to apples by introducing the tax equivalent yield, which I'll get to in a moment. But why is this theme so prevalent today? As I mentioned before, bond prices move up and down, which means that there are periods when a bond might trade at a premium to par and a period where it might trade at a discount to par, meaning the strategy of targeting the deepest discounts to par for tax efficiency is not really a new strategy. So why are we so excited about it today in particular? Well, because we have never seen this depth of discounts before. Despite the fact that we have in the past seen bond yields at these levels, although you have to go back to like 2007, never in recent memory have these yields been as tax efficient as they are today. And what we have here is, so we're illustrating the yield to maturity, the after-tax yield, and the tax equivalent yield of the Bloomberg Canada Aggregate Bond Index over the last 20 years, right? You can think of the Bloomberg Canada Aggregate as an amalgamation of all Canadian bonds with investment grade ratings issued over the last number of years. And they give us an idea of where the Canadian bond market is trading from a yield perspective. So all the numbers that I'll go through from this point forward will be on an average type basis, right? So as you can see here, the blue line, which is the yield to maturity, again, the yield that everybody sees because it's the only yield that's really quoted most of the times, has in the past been this high, as you can tell by the blue line. But never has the gray line, which is the after-tax yield, and the orange line, which is the tax equivalent yield, been as high as they are today. And again, I mean, a lot of people get confused with the tax equivalent yield metric, and I totally get it. It's a metric used for comparison purposes. It's a metric that allows for the comparison between a bond and a GIC or other par price products. So the tax equivalent yield can be interpreted as the yield that a GIC or the yield that a par priced bond would have to carry for it to have the same after-tax yield as the bond in question, right? So in other words, in this example that you see here, we're seeing an average yield to maturity of roughly 4.5%, but a tax equivalent yield of closer to 5, which means that for a GIC to compete with a bond such as this one, at a yield to maturity of 4%, it would have to carry a yield of 5%. And I'll show you some more extreme scenarios in a moment, but right here, right? So the previous slide illustrated the difference between pre-tax and after-tax yield metrics for the Canadian bond universe on average. Now, you can be selective and find even better tax efficiency opportunities by filtering for specific criteria. Now, in this chart, I illustrate the same yield metrics, but on a slightly shorter duration Canadian index, right? So in the particular index that I'm filtering for here is the Canadian universe between 1 and 5 years of maturity, right? Because GICs are only issued across a 1 to 5 year maturity timeframe, this is the comparison that I would use for bonds versus GICs, right? So you can see that the blue line here, which is the pre-tax yield on the bond, is pretty comparable to the GIC, right? So why would I buy a bond over a GIC? Well, because the bond's tax equivalent yield, which is the orange line, is about 50 to 100 basis points higher than the average GIC yield, because more of its yield is coming in the form of capital gains versus interest income, which is what the entirety of the GIC's yield to maturity is coming in the form of interest income. Right, so on an after-tax return basis, very different paths with bonds and GICs, despite the fact that the pre-tax yield is telling you a slightly contrary story, right? So in other words, what this orange line is telling you is that in order for a GIC to produce the same after-tax yield as the bond index, it would have to carry a yield of closer to 6%. Now, again, we are focusing on indices, so we're looking at averages here, but we can get even more selective with our choices and target the deepest discount bonds within these indices. In many cases, we can find bonds with 7, 8% tax equivalent yields, right? So why is the orange line and the gray line here, so high compared to history? And this is where the presentation, I think, gets really interesting. This is largely a function of the fact that never before has the price average of the constituents within the Canadian aggregate bond universe been this low. Right, so the average investment-grade Canadian bond is trading at around $90 versus a long-term average of about $108. Not only that, but their coupons have also moved significantly lower, as illustrated here. Right, so how do we get here? How do we get to an environment where the average Canadian bond is trading at $90 and the average coupon on those bonds is around the $3 mark? What led us to some of the lowest prices and coupons ever, and by extension, some of the most tax-efficient bonds ever? I'll go over 3 very important required ingredients to achieve these types of levels of discounts, and I'll go through them in order, right? So the first ingredient is you need lower rates. You need a fall in interest rates as the one we saw over the last 16 years, which was then exacerbated by the 2020 COVID-induced rates plummet. Then you need bonds to come to market during this low rate environment, that yellow circle, that 2020, 2021 environment. You need bonds to come to market during this environment, right? So the issuance of debt at these lower coupons as issuers took advantage of the new low rate reality available to them to issue more debt and to refinance old debt at some of the lowest yields and coupons that we've ever seen. Everyone and their grandma and their doc was refinancing at this environment because it made a lot of sense to do so. It made a lot of financial sense to do so. So okay, now you have the required rate environment. You have the second ingredient, which is the issuance of bonds during this low rate environment. Now, the third ingredient now is you need the price on those bonds to fall. You need the price on those bonds to fall below par so that most of that yield or a big portion of that yield can come in the form of capital gains. So you needed the third ingredient, which was higher rates. And we saw it. We saw an eventual very aggressive surge in the rate environment, courtesy of central banks as a way to fight these inflationary forces that we've been dealing with over the last 3 years. And you also needed that to allow this fresh batch of low coupon bonds that were issued during 2020 and 2021 to reprice much lower. disproportionately more so than higher coupon bonds, right? So when rates were low in 2020 and 2021, corporations had the luxury to issue at very cheap terms. As base rates eventually rose, those ultra low 2020 and 2021 bond coupons began to look extremely unattractive, resulting in severe pain as the bonds readjusted their price to the new yield reality, right? So in other words, prices dropped significantly below par in order for the bond's yield to keep up with the higher yields now available to investors, right? So a lot of these bonds issued at the rate depths of the pandemic will have roughly the same yield to maturity as other higher coupon bonds issued during different periods, all else equal. And again, this was possible as a result of the meaningful price drop on the lower coupon bond in order to compete with the new prevailing yield reality, right? And in that process, this dynamic also created extremely attractive opportunities for tax efficient yield pickup during this time. In fact, most of the bonds that were issued at the rate depths of the pandemic, 2020 and 2021, are now yielding between 7 and 8% on a tax equivalent yield basis, right? So Karim, I mean, that's really the crux of it. And now,
yeah, so Louis, if I could just summarize these three great points that you've made. In summary, as I said, basically right now, if we buy bonds that were issued 3 years ago, when interest rates are 1% or lower, basically that's all we're doing. Discount bonds is buying today bonds that were issued at $100 3 years ago. The same bonds that were issued at $100 3 years ago, we can buy them at $90 or between $90 and $92, which were issued at $100 3 years ago. And that's where the discount comes in, right? And this is all caused because interest rates have gone from 0 or 1% to 5% in a matter of 3 years, right? So this is just to summarize the three great points.
For sure, yeah. I mean, some of the most tax efficient bonds were the ones issued in 2020 and 2021 because, again, they came to market at tiny coupons. And then the second very important ingredient after that, so now you satisfy the fact that a small portion of your bonds yield will come from coupons. Now you need to satisfy the second step, which now you need a discount to par for most of it to come in the form of capital gains. So for that, you need pain. And there's really it's very difficult to find another time period in our lifetime where the pain in bonds was as severe as the 2022, 2023 time period. So really three ingredients that were required to get us here today, and they came quite aggressively. But yeah, you're absolutely right in that summary.
Right. Yeah. So now I guess one other point also I wanted to make here is it's interesting right now, as I say, that some of the greatest discount is actually in government bonds. We're seeing great opportunity, right? In Canada's or some of provincial bonds that we're seeing greater than in corporate bonds. Right, because the spreads have not widened, so we are actually not only able to get better after-tax returns over GIC, but also get a better credit rating because we're getting Government of Canada or provincial bonds, which are far more secure than any GIC one can get out there. Is that a fair comment?
That's a very fair comment. Not only more secure than a GIC, but you actually have the ability to sell it if you feel the need to whenever you want, as opposed to being locked in with a GIC for the term of its life. And you're absolutely right. I mean, so the reason why some of the best tax equivalent yields are coming from Government of Canada securities is because the Government of Canada tends to issue bonds across every interest rate scenario, meaning that they issued a lot of bonds in 2020 and 2021. A lot of these bonds came in at coupons of, as low as 0.25%. Priced at a deep discount to par today, which means that nearly all of their yield is coming in capital gains. So from a pre-tax perspective, you might look at the yield and not be as impressed by it, but the after-tax yield reality is completely different. And this is one of the rare instances where increasing quality is leading to an increase in yield, which usually our CFA books told us that's a bit different. If you want to increase your yield, you got to increase your risk and therefore drop your quality. This is one of the rare instances where you can, incur the risk of a AAA rated Government of Canada bond, but also pick up yield in the process on an after-tax basis.
Yeah, amazing. As you said, I don't think we've ever seen in recent memory any situation like this, not only improving credit quality, but improving your returns as well, right? I don't remember recently that ever happening.
Yeah, no, and the other reason why the discount bond theme is so relevant today is because it's not expected to last forever, right? A lot of these bonds that were issued, the most tax efficient bonds, the ones issued in, again, 2020 and 2021, will eventually mature. Corporations and the government are still issuing bonds today, but these bonds are coming in at a now new, very different yield reality than the ones that were issued in 2020. These are coming at 5% coupons, 6% coupons, right? So in a few years, I mean, this strategy will not be as effective as it is today. We still have a lot of time before that happens. But again, why we tend to emphasize how relevant the strategy is today. Unfortunately, it will not last forever.
Yeah, no, that's true. Very, very true. Well, Louis, thank you so much. Wonderful prep, wonderful presentation, wonderful recap on this particular thing. Before we close on this, one last thing I want you to sort of help, for the viewers, define, something that you and I use quite frequently, pull to par. The concept of pull to par, we sometimes use it without, you and I know what it means, but for the viewers who may not fully, appreciate what pull to par means, can you take 30 seconds to sort of describe what pull to par is?
Yeah, I mean, a pull to par is you can think of it as an ingrained math function within how most bonds operate. So bonds are issued at 100 throughout their life. They can move up or down, but at maturity, that bond wants to return back to par, right? So, and again, part of the reason why the discount bond theme is so relevant for somebody that's a buy and hold bond investor. We're buying bonds priced at, $80, $85, $90. That bond, if you hold it to maturity, will approach par as maturity approaches. It's almost like it's a natural pull. The bond wants to go back to 100 as maturity approaches. And that's really a function of the fact that, bond investing is a contractual agreement between you and the borrower to pay you back coupons on a contractual basis and pay you back your principal, which is 100 at maturity, right? So every bond that's purchased, if held to maturity, unless there's a default event, if held to maturity, it will naturally move to par, right? So we're buying a bond at 95. That bond over time will slowly move back to 100 as maturity approaches.
Yeah. So basically, in short, if I was to say that any bond generally is issued at 100 and will mature at 100. But in between, from issue date to maturity date, it may fluctuate. And today, we've got a situation where the bonds were issued at 100 a few years ago are now trading at a massive discount. And to maturity, they will pull back to par, from whatever they're trading, 91, 92, back to 100, because that's what bonds do. Issued at 100, mature at 100. Is that a fair comparison, fair comment?
It is. It's exactly right. We usually describe it as you can buy a bond at $90. The rate environment or the credit environment between now and maturity can make the price of that bond fluctuate up or down, but over time that bond will always return to par, right? So that is a fair statement, and it's usually something that calms people down when they see the price of their bond down, particularly across, the last, 2 to 3 year environment that we saw with rates rising aggressively. We saw a lot of these bonds reprice significantly lower. But if you're the type of investor that's simply looking to buy and hold, that bond will return back to par. It's been painful for existing fixed income holders, but for new money laying around, I think, buying a bond on 85, 90, where again, most of it will be taxed as capital gain is really a slam dunk idea in our opinion.
Yeah. Well, you took the words out of my mouth. It is the low-hanging fruit. It's a slam dunk opportunity that we have, right? So, well, Louis, thank you so much for your time, for your expertise in joining me in this webinar, in this recording of this, what you and I have talked over the last couple of years is a great, great opportunity that we have where we can not only get really, really good after-tax returns, but in a safe issuer like the Government of Canada, or like, some provinces and stuff like that. So thank you, Louis, for your time. Thank you for your expertise. Thank you for all of you who are listening into this presentation. My contact information is right on the screen right now. If anyone has got any questions, want to do a further deeper dive into this particular topic or any other investment opportunities as you see, please feel free to give us a call. My number is 416-956-8888. Again, 416-956-8888, or feel free to email me at karim.visram@rbc.com. Thank you again for everyone. And Louis, thank you again. Take care.
Thanks, Karim. It was my pleasure.
Okay, take care. Bye-bye.